California, the rules have changed. If there's debt that's been forgiven, all that exclusion and everything doesn't apply anymore for California. So you will have a tax liability for the amount of the debt that's been forgiven in California.
So this only highlights what we said in the beginning about the tax laws changing and the importance of tax planning.
Correct.
Waiting for 2014 to get your receipts together, that's not tax planning. It's already been done. The writing's on the wall. All you're doing now is bookkeeping.
Correct.
Right? The tax planning occurs now.
Right.
And naturally, you're a big advocate of the tax planning ahead of time, obviously. Is that something you guys do commonly?
Yeah. At Hamilton Tharp, we pride ourselves on working with our clients to teach them the difference between tax preparation, which is the compliance portion, and then tax planning, which is what you need to do now. October, November, December, we'll be reaching out to all of our clients to encourage them to come in and meet with us so that we can look at their individual tax situations and develop strategies that will help them minimize tax. We always do this, but this year I think it's even more important with all the changes in the laws and the increases in the tax. Even with federal, and then you throw in California, this is something that needs to be done now.
So the website, HT2, the number 2, CPA.com. That's the website, HT2CPA.com. So we talked about the 3.8% net investment, 20% capital gains. The big hits we're going to take as the highest tax bracket of 39-point-something%, 40% for the highest income earners. What are some of the scenarios you can think of where you're able to actually change what someone is doing when they see you September, October to lessen the tax implications come into the year?
Okay. Some of the things that we're looking at when we talked about earlier with the phase out for the itemized deductions was kicks in over $300,000. If we can work with, for example, a self-employed individual where they can somewhat control their income streams, maybe we look at reducing income this year in order to take advantage of maximizing their itemized deductions instead of just treating things as normal and letting it, reporting all the income this year and then losing out on those itemized deductions. So if we can control the income, that'll help out in that area. You can have clients defer income. If you have a big bonus coming, maybe you don't take it this year, you take it next year. And then in that scenario, if you're looking to make some significant charitable contributions, you'll do it in 1 year versus the other. Because we just don't look at this year. We'll look at 2 or 3 years down the road to see what's going on with this particular client, to see if there are any strategies we can come up, just short term, but also long term, as far as, like I said, not manipulating, but
manipulating
the income to where it is advantageous for our clients, and also with their deductions as well. And then also on top of that is taking your, you want to make sure you maximize all your retirement plan contributions that you can, maximize your IRAs, things of that nature. You want to get all that in place. So you at least, even though you can do that later on, you can at least strategize cash flow to make sure that all these things can take place.